Alright, so we've reached that time in which we're going to bring in ChartTrader, Brett Manning, to discuss some of his trades that he had going on today. And just as I say that, we get a pop in the market. So let's say hello before something else happens. What's up, Brett?
Hey, how you doing, Jim?
I'm doing well, thanks. So, let's see. Should we start chronologically with your S&P trade? I know we talked a lot about it, and we set it up pretty well. You even foreshadowed that you may be doing it around dinner time. Sure enough, I'm sitting down with the kids eating dinner, and there comes my alert. Yep. You want to walk through that one?
Yeah, sure. And, again, the time frame of this position is such that, little moves in the market today aren't really a factor. I in fact, expect it to probably go higher and test the 50-day moving average. And it's even possible that this one could get stopped out. I went in with a quarter size. I give it 40 points risk. That's really not that big a loss if it goes ahead and takes me out. I don't mind a positioning period. This is something I see as maybe a 2 to 3 week time horizon, maybe even longer, as far as the position and the general direction. What I didn't want to do is have it start to go straight down and suddenly be left with a conundrum as far as how to establish an anchor to the position, which is why I put on a bit last night. But to go through the basic gist of the idea, pretty much similar to what we talked about a couple different times, but I want to rephrase it in slightly different terms today. So the general phenomenon we've been seeing this earnings season is what? Is great reports. Stocks pop higher on the initial print, and then they start to run down the next day, and you end up with little change or even slightly down on a great report. And I don't think that it's surprising to anybody that this is a great earnings season in terms of the numbers that companies are posting, and even in terms of outlooks. I think that it was widely considered to be a strong likelihood that this was going to be a really strong earnings season. And what I think is really interesting is the fact that the stock market didn't run higher into earnings. And that's an important differentiating factor, because normally when that happens, there is a situation where something has arisen to create doubt about exactly how the reports are really going to come out, that maybe we have ramped up expectations too high. In my opinion, that's not the case this time around. And it's another factor, both of those things taken together, the fact that we didn't run higher into an earnings season that was full of great expectations, and the fact that we're not running higher as we start to see those great expectations more than fulfilled, all suggests one thing, and it's that by contrast inference that I like doing, which is there's something else that's dominating the tape of the market. My opinion about what that is that there's tens of billions of dollars that have been hooked into this market on the basis of a calculation that has to do with the relationship between risk-adjusted returns on dividend-paying large-scale portions of the equities market relative to the shorter end of the treasury curve. And the people involved in that kind of position are people who need to get some kind of return, and they were pushed out of the treasuries market because of the extremely low interest rates we saw really for most of the past several years, but in particular during 2015, 2016, and early 2017. And we're starting to see the other side of that trade now, as market participants such as insurance companies, endowment funds, sovereign wealth funds, pension funds, those types of market participants start to pull out of what is a risky way to get that return, which is dividend-paying equities, because they can also go down a lot. It's possible. You carry that risk, versus a risk-free way to get that return, which is buying short-term treasuries, where you can just live off the interest, and it's guaranteed by the federal government. So that move higher that we've seen in rates, particularly since November, is a move that has shifted that calculation in a meaningful way, and we're starting to see that money pull back out of the market. Just as it supported stocks in 2016 during the first half and during really almost into the election, basically preventing any declines from sticking, it is now, I think, standing in the way of gains, generally speaking. That's the basic gist, and there's one other element that I want to kind of add into that picture as another reason why I think it's reasonable to expect a weak equities market over the coming period, in a manner that can exist without any real fundamental downturn at all. All of these great growth estimates, all of this can actually fit into a market that's pricing as much as, I'm not looking for 15% downside, but it wouldn't be crazy given valuation. So that other factor that I think that could lead to a constriction in multiples, generally speaking, is something, and I'm going to be posting my chart book later today, and I'll go into this a little bit more, but I'll steal the analogy right now from that chart book, which is that of a trapeze artist in the circus. If you've ever been to the circus, if you've ever seen a trapeze act, then usually they kind of follow a certain pattern, which is a lot of really dramatic tricks during the first 3 quarters where there's a safety net down there. And people are willing to do quadruple flips or go through a ring of fire or something else. And then at the very end, the big crazy part, and so during this first part, there's usually a slip, and I wonder if it's kind of, almost intentional. Somebody can't quite grab somebody's hand, somebody falls into the safety net, the audience goes, whoa, and the person pops out, takes a bow, everybody applauds, he goes back up the ladder, right? That usually happens at some point. And then that sets up the big trick at the end, which is the drums roll and the safety net is taken away. And then you see a very mundane act for a few times across, but that's not really the point. The drama is just the risk below, and maybe a flip, maybe not even a flip, just a toss from one side to the other, and that's amazing because of the risk potential. And I think the reason why I think this is applicable to the current situation is because I think you tend to get higher multiples in a market where if there is some kind of potential downturn, even if it's all hypothetical, there's a lot of support underneath from the federal government and from monetary policymakers. You know that there's plenty of cuts coming. You know that there's plenty of room for fiscal stimulus. You know that there could be huge support, jobs programs, infrastructure, all sorts of stuff. When you know that that's there, the market can get a little more giddy. I think it's one of the reasons in the 1990s, if you remember, we had pretty much a balanced budget. We had pretty much, no debt. We kind of shifted to an entirely different situation, and obviously that was largely demographic and driven by the technology boom and all sorts of things, as well as having people, the baby boomers were in the prime period of their lives, and that supported that kind of situation, a huge demographic dividend. In other words, lots of people making the most that they would make at any time in their lives, having lots of disposable income, and very few little children and old people to take care of. And that sort of situation really balances the finances of a country. Right now we have very much the opposite situation. We're headed for, by far and away, the worst fiscal situation we've ever faced as a country. Because we did the tax cuts, essentially at full employment, at what you might see as the top of the cycle, it's sort of like shooting all the arrows in the quiver when there's nothing to shoot at, really. And we're going to end up with huge deficits going forward. And if we see a downturn in the economy, again, not saying there's going to be one, but just in that hypothetical scenario, as you think through risks, if you do see something like that, those deficits are going to be much higher because tax receipts go down and the government can't stop its basic spending. So you're going to see, maybe 1.5, 1.6, 1.7 trillion dollar deficits. That precludes any possibility, particularly if the Democrats take the House and we get more of a stalemate kind of situation, a gridlock situation in the federal government. That takes away any possibility that in an economic downturn that's not any kind of crisis, but is a clear downturn of some kind of fiscal support. And at the same time, the Fed has maybe 2 to 3 cuts in them. They don't go down by 25 basis points, and the last cut doesn't matter. You have to show that you've got other arrows in the quiver for anybody to react to it. So last cut doesn't matter. We're talking 50 to 75 basis point cuts in any hypothetical downturn. Really, we're headed toward 200 basis points. That's not a whole lot of room. So the safety net is out from under this market right now. And I think it's reasonable to consider a situation where we start to see, since we're past any kind of fiscal stimulus this cycle, as polls suggest the Democrats are likely to take the House at this point in November. It's going to be very hard to get the infrastructure bill done, going to be very hard to get healthcare movement, going to be very hard to get much of anything else out of the federal government. We've already got the tax break that's already figured into everything. That's already extrapolated into every future earnings report it's going to apply to. That's the current price of the market right now. So for all of those reasons, and for the fact that the market is acting right now like a market that can't seem to find enough of a catalyst to move higher, even when you give the bulls exactly what they want to see, we still end up kind of giving it back. We're flat now basically in the market so far in earnings season. It's been one of the best earnings seasons I've ever seen. And the market didn't run up into earnings season. So it all suggests a situation where when these immediate catalysts start to become less of a daily influence, this market is going to roll over and break through its February lows. And I want to be a part of that, and I think my current position will allow me to, and I think I should have an opportunity to add to it. I would say a target under 2,500. If you look at the 2450 area, that would put, with no fundamental deterioration, if we see, even taking into account the next couple quarters estimates for earnings growth, which is huge earnings growth, even pricing that in, so using like a blended price to earnings model for the S&P, we would end up at about 18 to 19 times earnings if we went down to 2450, which is still right in the middle of the zone for an aggressive bull market over the last 30 years. And so it's hardly a situation where you can make a bullish valuation argument that we are extremely underpricing stocks if you go to that level. It could conceivably go lower. It depends on the psychology of that kind of move. And if we find any other way to suggest that what is already being assumed for earnings growth, if you just look at what's being assumed over the next few quarters, we have to amp that up further and considerably further to change that on the basis of just your traditional long-only, equity-only money flows. We have to generate animal spirits, something to counter what I see as this exodus of non-traditional equity market participation that we've been kind of living off of for the last couple of years because of where interest rates have been. So there's that trade.
All right, so a couple of questions. First,
okay.
What would be the likelihood that there would be some type of mass exodus creating some type of black swan event, aside from a black swan event that would create it, but I'm saying that mass exodus being the event that would cause that. Let's start with that one. So have you factored that into the probability of this, and how would the market play out if so?
So as I just described, the downturn here, a bearish argument can be made on the market in the absence of any kind of fundamental deterioration, with existing expectations of extremely strong earnings growth performance over the next several quarters. If something were to come into the picture that started to change expectations there, where people started to temper the growth estimates, something actually, some kind of downturn or some kind of inflationary concern or something that would cause people to start to question the extremely rosy view on earnings, then I suppose that would do it. I don't know if there's any possible way that there could ever be some series of political events that could throw into question the permanence of the tax bill. That would obviously do the same thing. And I think it would have to be extraordinary occurrences to do that. I don't know about any. I'm not looking for a crash. I'm really not. We're starting to see sentiment go above middle ground, and this is kind of what I predicted when we talked last week. If we saw earnings like this, and I can promise you, right now sentiment is improving. You know, just because Amazon's at new all-time highs, best quarter in the company's history, Facebook looks fantastic, Intel looks fantastic, Microsoft knocked the cover off the ball. One company after another that are the kind of retail-oriented plays that really excite retail market participants in a big way are really showing highlight reel kind of results right now, and outlooks. And, you know, there's no real doubts mixed into those plays at this point. And with no real argument for why they might be headed for trouble. I mean, Facebook maybe has, you know, one could kind of construct something there, but I think they've kind of muddled through that pretty well as far as the PR side of things. And at the end of the day, you know, it's become a staple in people's lives. And even if people kind of feel a little bit wronged by something, that, you know, that's nothing that a PR firm can't help. So, you know, I don't think that there's an easy way to make a bearish argument on any of the kind of big buzz plays in this market. Since that's the case, and since they're showing good results, you can probably bet that The current pricing includes all of that, as well as expectations. So you're not really concerned about that from a bear standpoint at this point. There are other things that can drag the market down that people haven't widely assumed as part of the picture. And it's really, any trade like this, it's not about what is the case, it's about what you can infer might be the case in terms of a psychological transition. It's about how you can imagine the world appearing to people just around the next corner. So there's all the ingredients right now for the world that I'm imagining just around the next corner to become a little more clear. It's not absurd to see lower prices. There's nobody who can make an argument that it's absurd to see lower prices. And the market's starting to behave in a way as though it's got a kind of ceiling coming into place right now. And there's sentiment upticking based on these earnings, which means the market is transitioning into hands that are going to be easier to shake out down through lows if things start to break. So I'm not looking for any kind of crash, just an adjustment that seems to me is being suggested by the way the market is behaving. And again, as I always say, I like to position, size, and risk my plays from the standpoint of, I think you made a joke about having a picture of my wife with a disapproving look on her face on the desk, and that, that picture right there theoretically is staring at me as I decide what kind of risk to take on this thesis. So as long as I keep that in mind and keep the risk assessor as part of this plan, then I can have this thesis, I can get positioned for it, I can let it play out, and as long as I'm in the business of doing the right thing, which is closing the door to big losses and opening the door to big gains, then it's either going to work or it isn't. And if it doesn't, it's no big deal.
All right. So in terms of the time horizon here, I know you thought this could be something that's like a 2 to 3 week trade, maybe longer, maybe shorter, who knows. But keeping that in mind, would you call this, what you put on last night, the core position, giving yourself some room to play shorter term scalps, not necessarily adding to it? I know maybe you would add to that core position, but also trade this one within a given range as a daily scalp or an overnight swing trade, something like that. Would you keep that on the table as well?
So here's how I handle that decision-making situation. I will do more trading around it and just opening up to lots of activity if this starts to work well, and we get to a point where the VIX starts to really explode higher. Until that, I will probably just try to protect the fact that I have this exposure in place and get aggressive when I feel like we've sort of, gotten through the kicks and struggles of the sort of, this is a bad imagery, but the drowning person, the kind of, they get past the point where it just keeps trying to come back. Bulls keep trying to make another shot at it. Bulls keep trying to find another reason to find hope. And gradually we kind of get through that process and it just starts to roll over. And I just get a feeling based on the sense of the tape and the sense of the catalysts in play that it's just starting to move into a mode that I recognize. Then I'll probably add to the position maybe significantly. I've got a seed in place right now, and I would hope to add to that seed. And if we do start to see what I am right now envisioning, then after the break of the February lows, we could have a big downward move initially, something that looks kind of scary, kind of trapdoorish. Probably isn't that big a deal if you take a bird's eye view of things and step back, but we'll kind of in the moment have people feeling like, the end of the world is here right now. And that's exactly the type of feeling we want to see to start saying, well, mission accomplished for this move. But, probably see the VIX spike quite a bit. And then I'll probably want to leave open the ability just to be a trader in that type of environment, because that's the type of environment where I tend to make a lot on intraday trades. So I don't want to restrict myself from that. I want to catch that move, that break, that shift in psychology, and then free myself up to maneuver inside of that new type of space.
All right. Would you, if I recall, and I'm just trying to give the listeners a sense of how you might trade such a thing, you would leave your S&P position on and then do something like, say, in the NASDAQ or the Dow, right?
That is a possibility. It depends on, again, the last time I did this, I think, was sometime mid-February, and we had a VIX that had exploded higher. I had a long in the S&P that I eventually made an enormous amount, 180 points or something over the course of like 48 hours. But somewhere in there, I thought we saw an intraday pattern that looked like a relative gimme for a few hundred points in the Dow futures, and I took it. But the VIX was already at 34 or something. So that's a prerequisite for me taking that type of strategy, I think. There's no way I'm going to prevent myself from getting aggressive in an environment where we've got a VIX above 30.
Okay, fair enough. All right, enough about equities for the moment. Let's switch gears and dive into the crude oil trade. Pretty choppy market today. I've got the crude oil chart up so everyone can keep an eye on it, and it's the one right here in the lower middle portion of the screen. As you can see, it's been chopping around between, what about a 40-point range or so. Just walk us through what you were thinking. I know you set it up, but maybe some outlook of a potential trade going forward as well.
Yeah, so this morning was basically the idea that we have a situation where we've seen the dollar break out powerfully over the last few days. And I have noticed in situations in the past where you have a trending crude oil market, and particularly one that is fueled by speculative interest, as the current one is, and you look at a commitment of traders data set will show you that there's a tremendous amount of speculative interest that is part of this move in crude oil. And I have been there, from time to time as well, and I can understand the argument. If you see this boogeyman of, suddenly shale production is going to explode on the scene and just drown everything. And then you start to see tangible signs that there's a constraint there. There's something preventing that from happening. Then that's how you can get the hedges to come off for these shale companies. And if they start covering those hedges, then maybe you pop up through 70, 75. So that's probably, why there's all that money camping out there. And it's a lot of it's large-size speculators. It's people who know what they're doing, but they're crowded. And so there's a possibility of that unwinding. And so the question is, did they figure into this model, since there is also a crowded trade long the euro, or there was as of a week ago, and there's lots of different people who believe that there's a crowded trade short the dollar, as I think it was the number one on the crowded trades list for the Bank of America Merrill Lynch Fund Manager Survey, which is a statement that people believe that it's crowded. It doesn't mean it's crowded, but people believe it's crowded. So crowded short dollar, crowded long euro, crowded long crude. The people who are in crude probably then, if we take an average of all of this, don't expect a dollar rally. And so if we suddenly see a sharp dollar rally, it may be a situation where there's kind of a psychological breaking point and people start to de-risk. With the big move overnight in the euro, I was looking for that to start as we hit, the run-up into the pit open this morning for crude. A lot of times you see a 7 or 8:15 to 9 o'clock kind of move in crude oil, and then oftentimes it reverses for a few minutes off pit open. We didn't really get it, so I got back out, watched pit open happen, was sort of innocuous, got back in afterwards looking for the same thing, but lo and behold, what we saw from that point on, and actually just before that, is support come into the euro, big bounce in the euro, and it's really allowing that level to be protected well in crude. So we're not seeing that unwinding that I thought would spill us. I really thought we would check that 67 level early today there, but we didn't. So, it's always tough to break the back of a trend, and when you do, it's beautiful. It's really sharp. It's really fast gains, but you have to know that if you start to see it work for you, and then you start to kind of see it grind back to your stop level or your entry level after you've been in the money, it's better just to step aside, because you probably got a lot of people who've come in and start to bet against the market on really short-term, really weak-handed basis, and they're going to be really easy to pop out. So we saw them get popped out back above to, about 68.40 or 68.35, and now, we're just chopping around. And the euro, again, is bouncing. So it's tough to see anything dramatic in the euro into the end of the day, so I'll probably just stay away from that.
All right, so what are you looking at for next week? Outside of your S&P short, of course.
Outside of the S&P short, so there's the fallout of the dollar rally. I think it's a pretty sticky dollar rally because we're not seeing a lot of volatility in the bond market. This is something we talked about last week as well. When you start to get cheaper hedging terms for dollar exposure. So if you have foreign money and you want to put money into the United States in any form, oftentimes that requires, from risk managers at major institutions in Japan or Europe or wherever, that requires some kind of currency hedge. And the spread right now between the rates in the United States on sovereign debt and rates in Europe and Japan is, I think, as wide as it's been in like 25 or 30 years. So that is a really easy way to make money if you can manage to have a cost-effective hedge for the currency change. So you can borrow in Europe and buy U.S. debt and make, with not considering the hedge, you're making, 200 to 300 basis points just automatically. But the hedge up until a few weeks ago was more expensive than the profits. So it wasn't happening, and that was really keeping the dollar down. The money is not coming over from overseas to take advantage of the relative yield bet because it costs too much to hedge the exposure in dollars. But that's because we had a lot of volatility in the bond market. So as volatility in the bond market has gone down, the hedging has gotten cheaper, and we're starting to see that relative yield trade really take hold right now. So you've got a lot of people starting to play borrow euros, borrow yen, buy dollars in debt. And that is, I don't see how that's not going to be a relatively sticky phenomenon right now, which means that shapes the potential for the shakeout in everything that's loaded with speculative long interest in the commodities space. So this is the basis for the crude oil play. It's the basis for a possibility of a short in any of the metals. Look at copper. It's getting pretty much hammered today, I believe. And we are seeing silver give up everything it had taken a couple weeks ago. Gold is one that I've been focused on because I know that's one of the most crowded, and it's just seen, some of these big buzzworthy headlines like Jeffrey Gundlach saying, here comes something really exciting in gold. He probably owns half the gold market in the world, and he's coming out and saying that at Irisone. So that kind of thing, you've got that fervor already involved in that market. I have reasons to believe that gold will be higher 6 months or a year from now. I don't know what path that will take, but if we get a sticky dollar bounce with a lot of speculative money in there, one would think that could fall out of bed and check that 1250 level. So there's a number of different plays that kind of center on this sense of a relatively sticky bounce or move higher in the dollar. What could throw all of my conception of everything, including the equities play, off is if we started to see a sharp rally in bonds. So that would just be a resetting for me. I would just go back to the drawing board on every macro thesis I have right now. If we start to see U.S. long end rates start to fall precipitously, which seems extremely unlikely to me, but it is also a crowded short in Treasury futures. So it's not impossible that there could be something that comes out that, let's say there's something that hits that say, we're going to have the jobs data, I don't think it's next week, is it? Is it the week after? We're going to have the jobs data very soon for May, and what if we see, an extreme decline in second derivative wage growth? We could see treasuries rally like crazy on that. A big short squeeze. That would probably change all sorts of things for me. So that's one thing that my entire picture is vulnerable to.
All right. So one last thing. Just wanted to get your thoughts. I guess what we'll call North Korea capitulating. Good news, of course. But do we throw this into a headline? What if talks just break down and all of a sudden, is that another headline risk that we should even be concerned about? Or is this, are we going to be kumbaya and singing kumbaya all the way home? Yeah, kumbaya.
All right. So I want to just harken back to the last time you and I talked. I don't know if you remember this.
Of course I do.
Said, what would be amazing? Is if the market was coming in on a big gap up, and part of the story was some kind of signed pact about denuclearization of North Korea. I said that. That would be like the best. That would be the best short signal to me. Like that is something where it just offsets price. You can't necessarily trust it's going to mean anything about the shape of the universe going forward, right? But it is that symbolic gesture that, if you imagine a sort of algo view of news, That has to be a buy, but it doesn't have anything necessarily to do with any of the concepts that I think surround the idea of why we're set to break the lows. So it just displaces price up some, and it just creates a better entry for the short. Now, it really didn't move the market, in my opinion, at all. So, maybe that's sort of like, that's why really it wasn't even anything to be looking for, because it really doesn't have the ability to be a major catalyst for the equities market. I guess it has some kind of generalized, if it seems like there's follow-through here on this course, it's sort of a generalized deterioration in worry about some elements of the geopolitical side of things. But I don't know if it was like a front burner concern right now anyway, so probably isn't going to have a lot of capital react. Either way, it may have given me a slightly better positioning situation, but it's not significant, and I believe at this point anyways that probably we will see my current entry erode a little bit into the red, even if I'm right, and obviously a lot into the red if I'm wrong. But we'll see. My expectation when I put the position on last night was that it wasn't going to be the best price I get.
Okay, fair enough. Well, at least if that peace in Korea continues, Hawkeye, Pierce, and Klinger will be able to go home, so that's good news for them, right?
Finally!
All right.
Yeah.
That's one show I never understood. I never got it. Maybe I was just too young.
Good song, though.
Yeah. All right, my friend. Well, unless you have any more trades or something we should look out for ahead of the close, we'll let you go and touch base with you early next week.
You got it, Jim.
All right. Take care.
All right, you too.
All right.